Are we on the verge of the most deceptive market trap in human history, where soaring corporate profits mask a structural collapse of the global workforce? Imagine a world where the stock market hits historic highs, while the traditional concept of earning a living completely evaporates for millions of people before the end of this decade. Hello, this is WarmInsight. Today we're going to talk about global economic dynamics and strategic market outlook. Leaving a like and subscribing is a huge help to us. To truly understand the strange reality of our current financial landscape, we must picture the global economy as a massive, intricate ship sailing through highly treacherous waters. Right now, one of the primary engines of this vessel, which is China's massive industrial sector, is suddenly firing on all cylinders, completely defying expectations. At the exact same time, unexpected geopolitical storms are erupting across the horizon, keeping the entire crew on high alert. To complicate matters further, a revolutionary unseen force, in the form of artificial intelligence, is rapidly rearranging the deckhands, promising incredible speed and efficiency, but creating massive uncertainty about who will actually remain on board. To steer the ship, navigating this unprecedented journey requires much more than just an outdated map. It demands a keen observation of immediate shifts and a deep understanding of how the internal capabilities of our economic systems are evolving. When we look back at economic history, we see distinct moments where the surface layer of prosperity hidden, an underlying transformation of the global order. Consider the late 16th century during the Spanish Price Revolution, when a massive influx of silver from the New World made Spain look like an unstoppable economic superpower on the surface. Yet beneath that superficial wealth, the sudden distortion of currency and massive inflationary pressures were completely dismantling the domestic productive capacity of the empire, ultimately leading to multiple state bankruptcies. Today, we are witnessing a similar divergence. The headline indices frequently suggest structural resilience, but when you peel back the layers, you discover a deeply fragmented reality where traditional economic models are failing to predict nonlinear external shocks. Investors who blindly follow the headline numbers are walking into a historical trap, ignoring the powerful undercurrents that are actively reshaping the distribution of global capital. Let us focus our attention on the sudden and dramatic rebound occurring within the world's second-largest economy. In April, China's industrial sector shocked global analysts by recording a robust 24.7% jump in corporate profits. This represents the fastest rate of growth the country has seen in over 2 years, acting as a powerful beacon of stability against a backdrop of widespread global growth anxieties. To understand why this matters, we must look at the history of global manufacturing cycles, specifically the post-war economic miracle of West Germany. In the 1950s, known as the Wirtschaftswunder, back then, a massive, coordinated focus on industrial output and machinery, manufacturing transformed a devastated nation into the industrial locomotive of Europe. Within a single decade, completely altering global trade flows, China's current industrial surge is attempting a similar feat, injecting a massive dose of demand for raw materials, industrial components, and global energy products. This sudden industrial acceleration acts as a massive counter-narrative to the pessimistic reports that dominated mainstream financial media. For the past year, when a manufacturing powerhouse of this scale expands its profit margins by nearly a quarter in a single month, the ripple effects move rapidly through global supply chains. It stimulates resource-exporting nations, drives shipping volumes, and forces international competitors to reevaluate their production capacities. However, sophisticated investors know that this industrial resurgence does not occur in a vacuum. It is colliding directly with highly volatile geopolitical realities and a massive technological revolution that threatens to completely alter the relationship between capital and labor. The smart money is not simply celebrating the headline numbers coming out of East Asia. Instead, they are analyzing how this sudden burst of manufacturing energy will interact with a highly stressed global infrastructure. As this industrial engine roars to life, a much darker and more profound shadow is falling over the future of the global labor market. Serious concerns are mounting regarding the capacity of artificial intelligence to disrupt employment models on a scale never before seen in human civilization. Even spiritual and philosophical leaders like Pope Leo, alongside highly sophisticated prediction, Market participants on platforms like Kalshi are actively warning that AI could lead to a massive spike in structural unemployment before the year 2330. This is not a distant theoretical problem for the next generation. It is a looming structural transformation that is unfolding right now. To contextualize the scale of this disruption, we must examine the first industrial revolution in Great Britain. During the early 19th century, when automated weaving frames were introduced to textile mills, it triggered the famous Luddite riots of 1811, where highly skilled workers destroyed machinery because they realized their labor was being permanently devalued. The critical difference today is the absolute speed and cognitive nature of the automation. In the past, machines replaced muscle. Today, artificial intelligence is replacing mind. The historical transition from an agricultural economy to an industrial one took generations, allowing the workforce time to adapt, reskill, and transition into new sectors. The current digital revolution is occurring across a span of mere years, threatening to displace knowledge workers, creative professionals, and administrative staff simultaneously. This massive shift introduces profound questions about wage stagnation, the erosion of the middle class, and the structural integrity of our social safety nets. When traders on Kalshi begin aggressively pricing in long-term unemployment risks, they are signaling that the traditional relationship between corporate productivity and human employment is permanently breaking down. Corporations are achieving unprecedented efficiency and scaling their earnings, but they are doing so by severing their dependence on large-scale human workforces. This technological displacement creates a powerful psychological phenomenon in the public markets, leading directly to intense herd behavior and cognitive biases. When mainstream media outlets broadcast sensationalized narratives about the rise of autonomous machines, it triggers a dual emotional response among retail participants. On one hand, you see an intense, desperate fear of missing out, which drives regular investors to mindlessly chase any stock, with a vague connection to artificial intelligence. On the other hand, you see sudden panic selling in traditional, labor-intensive industries that are deemed vulnerable to immediate automation. This hyper-reactive behavior is highly reminiscent of the dot-com bubble of the late 1990s, where companies merely appended .com to their names to see their valuations double overnight, without possessing a single dollar of sustainable revenue or a viable business model. The crowd overreacts to short-term hype, while completely failing to analyze fundamental values or the nuanced, gradual nature of actual technological integration. While the herd is busy making emotionally driven decisions, the truly sophisticated investors are quietly executing a highly disciplined, contrarian playbook. Smart money does not blindly buy into the collective euphoria, nor does it succumb to widespread panic. Instead of chasing hyperinflated megacap technology stocks, sophisticated market participants are systematically identifying undervalued foundational companies that possess robust, realistic strategies for integrating advanced technology to enhance their existing cash flows. Furthermore, given the impressive rebound in Chinese industrial profits, these contrarian players are selectively increasing their exposure to overlooked international equities and manufacturing sectors, capitalizing on the fact that mainstream sentiment remains overly cautious and fearful. They recognize that market inefficiencies are birthplaces for massive generational wealth, and that true financial security is built by purchasing high-quality, cash-generating assets when the general crowd is looking the other way. To insulate a portfolio from these violent macro shifts, we must also analyze the structural elevation of the geopolitical risk premium. The ongoing unresolved conflicts in the Middle East continue to inject a persistent layer of volatility into global energy and commodity markets. This is not merely a localized political issue. It is a direct threat to the primary arteries of global trade and resource allocation. To understand the gravity of this situation, we can look back at the 1973 oil shock, where an embargo completely disrupted Western economies, triggered a massive wave of stagflation, and forced central banks to enact drastic monetary tightening that crushed speculative asset prices. Today, the constant threat of supply chain blockades and infrastructure vulnerability forces multinational corporations to completely abandon just-in-time inventory models in favor of highly expensive localized redundancies, structurally elevating global inflationary pressures. This environment of elevated geopolitical tension directly benefits specific resilient commodity producers, as seen in the sustained strength of major resource companies like Canadian Natural Resources Limited. When traditional trade routes are compromised, localized, stable energy producers become incredibly valuable assets. The ripple effects of these supply shocks extend far beyond the fuel pump. They impact fertilizer production, chemical manufacturing, agricultural transport, and the fundamental cost of doing business globally. Central banks find themselves trapped in an incredibly difficult position, forced to balance the urgent need to control supply-driven inflation against the imperative to support domestic economic growth. Traditional economic models struggle to cope with these highly unpredictable, non-linear external shocks, meaning that standard diversification strategies are no longer sufficient. To protect wealth from sudden geopolitically induced market dislocations, when we aggregate these powerful forces, we can clearly see two distinctly divergent paths for the global economy over the next several years. The institutional bullish scenario envisions a highly coordinated, sustained global economic recovery. In this optimistic view, China's robust industrial rebound acts as a massive locomotive that single-handedly pulls global trade and commodity demand out of stagnation. This positive momentum is beautifully amplified by rapid advancements in artificial intelligence, which successfully transcends mere technological novelty, to become a profound driver of structural productivity across retail, healthcare, and logistics, ultimately birthing entirely new industries and high-paying jobs. Simultaneously, a steady easing of global inflationary pressures allows major central banks to decisively pivot toward accommodative monetary policies, cutting interest rates and unleashing a massive wave of consumer spending and corporate capital investment, while geopolitical tensions remain safely contained. Conversely, the institutional bearish outlook paints a starkly different and highly cautionary picture. This scenario warns of a sudden escalation in critical trade corridors, leading to severe logistical blockages and an aggressive spike in energy and commodity prices. In this darker reality, the much-vaunted artificial intelligence revolution fails to create a smooth labor transition, resulting in widespread rapid displacement of white-collar and blue-collar workers, without any viable mechanism for reskilling. This sudden loss of earning power dampens aggregate consumer demand and severely exacerbates wealth inequality, triggering social friction. Meanwhile, sticky supply-side inflation forces central banks to keep interest rates restrictive for an extended period, tipping major economies into a prolonged, painful recession. This economic contraction, combined with a deep correction in global real estate and selective tech sector, volatility spilling into broader indices, triggers a massive systemic financial deleveraging event. Faced with these two starkly contrasting futures, the elite institutional playbook abandons speculative guesswork and instead relies on a highly disciplined asset allocation seesaw. The current overarching market sentiment is best described as a state of nervous bullishness, where widespread greed for technological innovation is constantly fighting an underlying fear of geopolitical and inflationary shocks. To navigate this delicate balance, the optimal baseline capital shield structures wealth into a highly specific 55-35-10 allocation matrix. 55% of capital is dedicated to high-quality stocks, 35% is placed firmly into ultra-safe, defensive assets, and 10% is held in pure liquid cash. This precise distribution ensures that an investor remains positioned to capture explosive upside movements, while maintaining a massive, shock-absorbing cushion against sudden systemic failures. Within the 55% equity sleeve, capital allocation must be highly selective rather than speculative. Instead of placing dangerous bets on unproven single-stock technology plays or highly volatile meme stocks, wealth should be funneled into broad, highly liquid vehicles with proven corporate earnings, such as the Invesco, QQQ Trust, or the Technology Select Sector SPDR Fund. This focuses your tech exposure exclusively on elite enterprises that possess massive cash reserves and robust, highly practical blueprints for integrating artificial intelligence. To balance this digital exposure, investors must incrementally accumulate global industrials via the Industrial Select Sector SPDR Fund and essential materials through the Materials Select Sector SPDR Fund, perfectly positioning the portfolio to reap the long-term rewards of the massive manufacturing recovery surging through East Asia. Stability is further reinforced by holding defensive sectors like healthcare, utilities, and consumer staples, which historically maintain their values, regardless of the broader macroeconomic climate. Geographically, true capital preservation requires a sophisticated balance between domestic and international markets, incorporating a deliberate tilt toward undervalued global opportunities. While the United States market has consistently demonstrated incredible leadership in technological innovation, its current valuations are undeniably stretched, and it faces complex domestic headwinds including sticky inflation and unpredictable policy shifts. International markets, particularly emerging economies, offer highly compelling valuations and crucial diversification benefits. By allocating capital to diversified international vehicles, like the iShares Core MSCI Emerging Markets, ETF investors can effectively capture growth patterns that are entirely uncorrelated with domestic performance, acquiring premium industrial and consumer assets at a massive relative discount. In this environment of heightened volatility and selective sector corrections, the practice of dollar-cost averaging transcends being a simple tip and becomes an absolute tactical imperative. Systematically investing a fixed amount of capital at rigid, regular intervals effectively removes human emotion from the equation and smooths out your average entry price over time. This disciplined approach completely eliminates the dangerous temptation to time the exact top or bottom of an unpredictable market. Coupled with this systematic entry, holding a dedicated 10% cash reserve ensures that you always possess an immediate defensive buffer against unexpected liquidity crises, while simultaneously holding dry powder to aggressively buy premium, cash-flowing assets at steep discounts when a market correction occurs. Regular portfolio rebalancing ensures that your risk exposure never drifts away from your core financial objectives. The ultimate lesson of economic history is that periods of profound technological disruption and intense geopolitical flux always precede the birth of an entirely new economic paradigm. From the dawn of the first industrial revolution to the chaotic birth of the dot-com era, the financial markets have always adapted, ultimately destroying speculative herders while lavishly rewarding those who patiently position themselves in alignment with deep underlying structural currents. Wealth is not built by frantically reacting to every minor, daily ripple on the surface of the market, but by understanding the deep macroeconomic tides and steering your capital toward enduring fundamental value.